Welcome students, I am Dr. Vijaya, Assistant Professor. Today we are going to see unit number 20, Laws of Insurance from Block 5, Insurance. Insurance Law. Insurance law falls into three major categories. First, the insurance company will hire lawyers to represent the insured in case she is sued for something related to her insurance contract. These are known as insurance defense attorneys. For example, an automobile insurance company will hire an attorney to represent an insured driver when she gets sued for causing another driver's injuries. The second category of insurance law helps insured people determine when an insurance company must pay a claim. Third, insurance companies typically hire attorneys to make sure the company complies with all the applicable laws and regulations, which can vary by state. In order to understand insurance law, it is useful to understand insurance first. Insurance is nothing but a contract in which one party pays the money, the other one promises to reimburse the first for certain types of losses if they occur. There are many types of insurance, and the government runs some kinds of business like social security, disability, workers' compensation, and unemployment insurance. However, the term law refers to the law surrounding private insurance. The most common types of private insurance are health insurance, automobile, liability insurance, homeowners insurance, life insurance, title insurance, and malpractice insurance. Insurance law meaning. Insurance law is the practice of law surrounding insurance, including insurance policies and claims. It can be broadly broken into three categories: regulation of the business of insurance, regulation of the content of the insurance policies, and regulation of claim handling wise. Next, we will see the term about insurance ombudsman. Ombudsman. The institution of insurance ombudsman was created by Government of India under the notification dated 11th of November 1998. The purpose of this is to make quick disposal of the grievances of the insured. The institution helps to generate and sustain the faith and confidence amongst the consumers and the insurers. Functions of insurance ombudsman. Insurance ombudsman typically has two types of functions: conciliation and award making. The institution is authorized to receive and address the complaints of the customers. Such complaints may associate to any grievance against the insurance service provider, like any total or partial denial or refusal of claims of the insurance company, disputes related to payable or paid premiums, disputes related to the legal structure of the policy's wordings, delay in the process of settling claims, not issuing insurance documents related to the policy even after receiving the premium amount. However, the powers of insurance ombudsman are restricted to the insurance contracts value not more than 20 lakhs. Insurance law regulations. Insurance law is the practice of law surrounding insurance, including insurance policies and claims. Whether the insurance company has enough capital to have a sound and secure business, what premiums a company can charge for a policy, requirements for inclusion in an insurance policy, measures to ensure that insurance companies engage in fair competition without price fixing, penalties for bad faith practices when people must buy insurance like auto insurance minimums in some states. Law relating to insurance. There are mainly four laws are concerned with the insurance business of India as follows. Number 1, insurance. Number 2, life insurance. Number 3, general insurance. And number 4, IRDA. IRDA, Insurance Regulatory Development Authority of India. The Insurance Regulatory and Development Authority is the main organization or supervisory body that regulates the insurance sector in the country. It sets rules and regulations for the functioning of the insurance industry. Its sole purpose is to protect the interests of policyholders and to develop the industry on the whole. The IRDA or IRDAI regularly issues advisories to insurance companies in case of changes to the rules and the regulations. The regulator guides the insurance industry in promoting the efficiency in the conduct of insurance business, all the while controlling the rates and other charges related to insurance. The IRDA is an autonomous and statutory body which is responsible for managing and regulating insurance and reinsurance industry in India. IRDA is a 10-member body, a chairman, 5 full-time members and 4 part-time members. It was constituted under an Act of Parliament in 1999 and the agency's headquarters is in Hyderabad. Next, we move on to the establishment of IRDA. Following the recommendations of the Malhotra Committee in 1999, the Insurance Regulatory and Development Authority, that is IRDA, was constituted to regulate and develop the insurance industry and was incorporated in April 2000. The IRDA is a regulatory body under the jurisdiction of Ministry of Finance, Government of India, and is tasked with the regulating and licensing the insurance and reinsurance industries in India. It was constituted by the Insurance Regulatory and Development Authority Act 1999, an Act of Parliament passed by the Government of India. The agency's headquarters are in Hyderabad, Telangana, where it moved from Delhi in 2001. Next, we see what are the functions of IRDA. According to Section 14 of the IRDA Act 1999, lay down the duties, powers and functions of IRDA. The functions of the IRDA are defined in Section 14 of the IRDA Act 1999 includes issuing, renewing, modifying, withdrawing, suspending or cancelling registrations. Next, protecting policyholder interest. Number 3, specifying qualifications, the code of conduct and training for intermediaries and agents. Next, specifying the code of conduct for survey and loss assessors. Next, promoting efficiency in the conduct of insurance business, promoting and regulating professional organizations connected with the insurance and the reinsurance industry, levying fees and other charges, inspecting and investigating insurers, intermediaries and other relevant organizations, and regulating rates, advantages, terms and conditions which may be offered by the insurance not covered by the Tariff Advisory Committee under Section 64U of the Insurance Act 1938, specifying how books should be kept, regulating company investment of funds, regulating a margin of solvency, supervising the Tariff Advisory Committee, specifying the percentage of premium income to finance schemes for promoting and regulating professional organizations, specifying the percentage of life and general insurance business undertaken in the rural or the social sector, specifying the form and the manner in which books of account shall be maintained and the statement of account shall be rendered by the insurance and other insured intermediaries. Next, we will see what are the major objectives of IRDA, that is aim of IRDA. The main objective of the Insurance Regulatory and Development Authority of India is to enforce the provisions under Insurance Act. The mission statement of the IRDA is to protect the interest and fair treatment of the policyholder, to regulate the insurance industry in fairness and ensure the financial soundness of the industry, to regularly frame regulations to ensure the industry operates without any ambiguity. Next, we will see some features of IRDA. Following are the salient features of the apex body, the Insurance Regulatory and Development Authority of India. First, it acts as a regulator for the insurance industry, protects the policyholder's interest. Next, rules and regulations are framed by the apex body under the Section 114A of the Insurance Act 1938. It is entrusted under the Insurance Act to grant certificate of registration to new insurance companies to operate in India, oversees the insurance industry's activities, ensures sustained development of insurers and policyholders. Next, we will see the important role of RDA in the insurance sector in India. The main role of the IRDA in to protect the policyholders' interest, to help speed up the growth of the insurance industry in an orderly fashion for the benefit of the common man, to provide long-term funds to speed up the nation's economy, to promote, set, enforce and monitor high standard, so integrity, fair dealing, financial soundness and competence of the insurance providers, to ensure genuine claim shall settled faster and efficiently, to prevent malpractices and fraud. The IRDA has set up a grievance redress form to ensure the policyholder is protected, to promote transparency, fairness and systematic conduct of insurance in the financial markets, to build a dependable management system to make sure high standards of financial stability are followed by the insurers, to take adequate action where such high standards are not maintained, to ensure the optimum amount of self-regulation of the industry. And these are the latest guidelines and rules of RDA for the insurance sector. The revival period is extended to 5 years in respect of non-linked policies. The option of computation up to 60% pension is allowed in respect of pension products. For linked pension products, a facility for partial withdrawal is allowed. Open market operations are allowed in respect of annuities. The settlement option period is increased to 10 years or the original policy term, whichever is lower. Switches are allowed during the settlement period. Insurers are now allowed to design individual term, group term, credit and micro insurance products. Group products governed by provisions are modified. Linked viable products is removed as a linked product structure. Next, we will see what is meant by insurance repository. Insurance repository means a company formed and registered under the Companies Act 1956 and which has been granted a certificate of registration by IRDA for maintaining data of insurance policies in electronic form on behalf of insurers. Honorable Finance Minister has launched the Insurance Repository System initiated by the IRDA to hold insurance policies in electronic form. This system was launched on 16th September 2013. Next, organizational structure of IRDA. Organizational structure of IRDA, that is the composition of IRDA is as per the section 4 of IRDA Act 1999. The composition of the authority is chairman, 5 whole-time members, 4 part-time members, and the members are appointed by the Government of India. Next, we move on to the Insurance Act 1938. The Insurance Act 1938 is a law originally passed in 1938 in British India to regulate the insurance sector. It provides the broad legal framework within the industry operates. The Insurance Act 1938 is a law originally passed in 1938 in British India to regulate the insurance sector. It provides the broad legal framework within which the industry operates. The Insurance Act has 120 sections and 8 schedules. Under it, only an Indian company as defined and registered under Companies Act 1956 is allowed to operate in India. Its foreign entity owned equity should not exceed 49% as of 2015. It must have a license from Insurance Regulatory and Development Authority of India. In March 2021, the Insurance Amendment Bill 2021 was passed by the Parliament of India, which increased the maximum permissible foreign direct investment in the insurance sector up to 74% from the previous limit of 49%. The Insurance Act originally passed in the year 1938, however, it amended for several times. Its latest amendment on the Insurance Act was the IRDA itself, when it became the authority to perform many tasks required to be done under the Insurance Act, such as issuing license, issuing registration certificates, monitoring compliance with the provisions of the Act, issuing directives, laying down norms, etc. The all above said functions were performed by the Controller of Insurance earlier as per the Insurance Act 1938. And these are few salient features of the Insurance Act 1938. The following are the salient features of the Insurance Act 1938. Constituting a Department of Insurance to supervise and control insurance business. Compulsory registration of insurance company and submission of annual financial reports. Provision for initial deposits to allow only serious players in the field. Compulsory investment of life fund to the extent of 55% in government approved securities. Prohibiting rebating, restriction on payment of commission and licensing of agents were other important provisions to bring in a sort of professionalism into this business. Periodic evaluation was made compulsory to assess financial viability of the insurance companies. Provision was made for policyholders director in the board. Policy formats were standardized and premium tables were to be certified by an actuary. The Insurance Act 1938 is enacted with the objective of consolidating and amending the laws relating to the business of insurance. This act further regulates the insurance business in India. Next, we will see the term Life Insurance Act 1956. The LIC of India was set up under the LIC Act 1956, under which the life insurance was nationalized. As a result, business of 243 insurance companies was taken over by LIC on 1st September 1956. Life insurance business in India was nationalized with effect from January 19, 1956. On the date, the Indian business of 16 non-Indian insurers operating in India and 75 provident societies were taken over by Government of India. Life Insurance Corporation of India Act was passed by the Parliament on June 18, 1956 and came into effect from July 1956. Life Insurance Corporation of India commenced its function as a corporate body from September 1, 1956. Its working is governed by the LIC Act. The LIC is a corporate having perpetual succession and a common seal with the power to acquire, hold and dispose of property and can by its name sue and be sued. Provisions and objectives of LIC. The LIC was established with the following objectives and provisions: spread life insurance widely and in particular to the rural areas, to the socially and economically backward classes, with a view to reaching all insurable persons in the country and providing them adequate financial cover against death at a reasonable cost. Maximization of mobilization of people's saving for nation building activities. Provide complete security and promote efficient service to the policyholders at economic premium rates. Conduct business with utmost economy and with the full realization that the money belongs to the policyholders. Act as trustees of the insured public in the individual and collective capacities. Meet the various life insurance needs of the community that would arise in the changing social and economic environment. Involve all people working in the corporation to the best of their capability in furthering the interest of the insured public by providing efficient service with courtesy. Role and functions of LIC. The functions of LIC is divided into primary functions and secondary functions. It collects the savings of the people through life policies and invests the funds in a variety of investments. It invests the funds in profitable investments so as to get good return. Hence, the policyholders get benefits in the form of lower rates of premium and increased bonus. In short, LIC is answerable to the policyholders. It subscribes to the shares of companies and corporations. It is a major shareholder in a large number of blue chip companies. It provides direct loans to industries at a lower rate of interest. It is giving loans to industrial enterprises to the extent of 12% of its total commitment. It provides refinancing activities through SFCs in different states and other industrial loan giving institutions. It has provided indirect support to industry through subscriptions to shares and bonds of financial institutions such as IDBI, IFCI, ICICI and SFCs etc. at the time when they required initial capital. It is also directly subscribed to the shares of Agriculture Refinance Corporation and SBI. It gives loan to those projects which are important for national economic welfare. The socially oriented projects such as electrification, sewage and water channelizing are given priority by the LIC. It nominates directors on the boards of companies in which it makes its investments. It gives housing loans at reasonable rates of interest. It acts as a link between the saving and the investing process. It generates the saving of small savers, middle income group and the rich through several schemes. Next, we see a new topic called General Insurance of Business. It is amended by the Act 1972. An act to provide for the acquisition and transfer of shares of Indian insurance companies and undertakings of other existing insurance in order to serve better the needs of the economy by securing the development of general insurance business in the best interest of the community and to ensure that the operation of the economic system does not result in the concentration of wealth to the common detriment for the regulation and the control of such business and for matters connected therewith or incidental thereto. General insurance industry in India was nationalized and a government company known as General Insurance Corporation of India was formed by the central government in November 1972. General insurance companies have willingly catered to these increasing demands and have offered excessive of insurance covers that almost cover everything under the sun. Next, we see what are the objectives of the General Insurance Corporation. To carry on the general insurance business other than life, such as accident, fire, etc. To aid and achieve the subsidiaries to conduct the insurance business. Next, to help the conduct of investment strategies of the subsidiaries in an efficient and productive manner. Role and functions of General Insurance Corporation. Carrying on of any part of the general insurance if it thinks it is desirable to do so. Aiding, assisting and advising the acquiring companies in the matter of setting up standards of conduct and sound practice in general insurance business. Rendering efficient services to policyholders of general insurance. Advising the acquiring companies in the matter of controlling their expenses, including the payment of commission and other expenses. Advising the acquiring companies in the matter of investing their fund. Issuing directives to the acquiring companies in relation to the conduct of general insurance business. Issuing directions and encouraging competition among the acquiring companies in order to render their service more effectively. Thank you. This is the end of our session. Thank you.